Picture this. You've just finished a hard month flipping burgers at McDonald's. You get an email saying you've been paid $2,000, but your bank account only gets $1,456. You scroll down the stub. Federal income tax, state tax, Social Security, Medicare. This is the modern ritual of giving away a chunk of your money, and they expect a thank you. Taxes are the cost of civilization. They build roads, fund schools, inspect taco trucks, and fund defense. There are different types: income tax on what you earn, sales tax on what you spend, and capital gains tax on investment profits. Nearly everyone pays Social Security tax, forced retirement savings, and Medicare tax, health insurance for seniors. Filing taxes. The government knows what you owe but makes you guess. Get it right? Fine. Get it wrong? Trouble. Yes, taxes are annoying, but countries with higher rates often have a higher quality of life. Banks, you deposit money, imagining it's guarded in a vault. In reality, it's already lent out. Banks aren't safes, they're middlemen. When you deposit $1,000, the bank might lend $900 to someone buying a jet ski. This is fractional reserve banking. They keep only a fraction on hand, assuming not everyone will withdraw at once. It works until it doesn't. Remember 2008. Banks make money by lending at higher interest than they pay you. They entice deposits with convenience, interest payments. Borrow $1,000, pay back $1,280. Why? The interest rent for using someone else's money. When you borrow, it's a cost. When you save or lend, it's a reward. Simple interest is a flat fee. Compound interest is where interest earns interest. A missed credit card payment can turn a $12 burrito into $50 regret. But compound interest also builds wealth. Invest at 7% annually, and $100 becomes $200, then $400. Interest is the engine behind debt and wealth. The rule: if you're paying interest, kill it fast. If you're earning it, let it grow. Inflation: buy a bag of chips, pay 30% more. That's inflation. Money slowly loses value. Your $5 bill is still $5, but it buys less. Causes include too much money chasing too few goods, supply chain issues, or even expectations. If people think prices will rise, they spend more, driving prices up. A little inflation, around 2%, is normal. High inflation kills savings. Governments fight it by raising interest rates, making borrowing expensive and cooling spending. Recessions. A recession is when the economy shrinks for 2 straight quarters. Jobs vanish, spending drops, and fear sets in. Causes include high interest rates, global crises, or natural economic cycles. Think of the economy as a party. The music stops, lights flicker, and reality hits. Recessions are painful resets but don't last forever. Governments may lower rates or offer stimulus to revive growth. Credit scores. A credit score is a 3-digit number, 300 to 850, that measures trust, not wealth. Lenders use it to decide if you'll repay. Below 580 is risky. Over 750 is excellent. It's based on payment history, credit utilization, account age, credit mix, and new credit application. So improve it, pay bills on time. You can have no debt and a poor score if you lack credit history. Learn the rules to make the system work for you. Currency: money isn't real, it's a social construct. A dollar has value only because society agrees it does. Governments print it. Central banks regulate it to prevent too much inflation or too little economic paralysis. Money facilitates trade and organizes society, built entirely on shared trust. Investing to beat inflation. Investing means putting money to work. Options include stocks, ownership in companies, bonds, loans to entities, funds, collections of assets, and real estate. Investing isn't about luck, it's about starting early, diversifying, and being patient. Let compound growth work over decades. The real risk isn't market swings, it's not investing at all. Value is subjective. A rock is just a rock unless it's gold. Then humans value it more. Creating value is key to wealth. Steve Jobs created the iPhone. Doctors provide vital services. Luxury brands sell perception. If you can create or convey value, you can earn money. Time is your most valuable asset. Most people trade time for money. Wealth builders learn to make time work for them, especially through investing. Money invested consistently over decades multiplies. Ordinary people can retire wealthy not by beating the system, but by using it patiently. If this story resonated with you, please subscribe, like, share, and comment below. Your thoughts encourage more content like this. Thank you for reading. Until next time.